Great. We're back again after our tea break, and delighted to have a really interesting session with Danielle. Is the head of real estate disputes team at CMS, and I can only imagine, Danielle, you are incredibly busy at the moment. Danielle, I'm going to hand over to you to introduce your session and your panelists.
Hi, thanks, Jonathan. Yes, welcome to the panel. If I can get everybody to turn their videos on, we've got Theodor Kubak, Erik Jacobs, and Frank Croston all joining us today to talk about who bears the pain, the new normal for landlord and tenant. So yes, very topical and unprecedented times that we're all in. And so we're all trying to work out what that new normal is. But before we sort of kick off our debate, I thought it's quick round of introductions. So I'm Danielle Drummond-Brassington, partner and head of real estate disputes at CMS, and as Jonathan said, very busy at the moment, trying to navigate that new normal. Let me hand over to Theodor to introduce himself.
Good afternoon, everyone. My name is Theodor Kubak. I'm managing partner within Arbireo Capital, managing a hotel fund, as well as managing partner to Value One Arbireo Hospitality, developing and managing some estates in Portugal, Italy, and Austria.
Thanks, Theodor. Over to you, Erik.
Yeah, hi, Erik Jacobs. I represent a Thai-based family office who is actively investing in Europe, and we invest on the real estate side as well as on operating companies. So we have a management company in Europe that is active both through management agreement and leases. As well, we are in food and beverage retail where we have some sizable leases. So yeah.
Thanks, Erik. And over to you, Frank.
Hi, Danny. My name is Frank Croston, Hamilton Hotel Partners. We merged with Pyramid Hotel Group out of the US in February, and we now have a platform of 140 hotels across the US and Europe with over 5 billion of assets under management. And we're very involved in individual situations with leases and heavily engaged at the moment in restructuring discussions.
Great, thank you. So I can invite anybody to post questions as we go. I can see them as they come up. We're also running a poll throughout this debate, which is who needs to bear the economic consequences of COVID-19 in a lease situation, landlord or tenant. We've taken away the sit on the fence option of both, so just trying to gauge views. So again, just feel free to slide that across to polls and votes, landlord or tenant, and we'll share the results as we go. So let's just jump straight in with the big question about, is it actually possible to share the pain at the moment, or do we need to see a major shift between landlords and tenants before that's possible? Frank, I'll come to you first because I've heard you talk about the landlord and tenant relationship as the unaffordable relationship. So I think you obviously think that there's got to be a shift. So let's hand over to you.
Yeah, I think the problem with the traditional lease model is it's not really designed well to withstand the cyclicality of the industry. The industry is inevitably cyclical and correlates very well with GDP. And so the tenant's very happy in a boom market and then can have an unsustainable burden of cost in a bust market. And the problem with this COVID crisis is that it's worse than any previous crisis because we have actually gone to zero income. So I think what both parties to the play need to focus on is building a more sustainable model that takes us through the cycle. And everybody will come up with their own variation, but I think the key ingredients are a lower base rent that can survive through the cycle, and probably a higher variable component based either on revenue or profits delivered that rewards the landlord disproportionately when times are good. So it need not be that over the length of a cycle either party bears more pain, but type of relationship is much more sustainable and would avoid some of the real problems we're seeing at the moment.
We're starting to see a lot of talk about variable rents and a certain proportion of them. But coming to Theodor, what's your view? Do you think there needs to be a change to help share that?
I certainly think so, especially to Frank's point in terms of cyclical nature of the business. However, I would go beyond that. There's more than one or two parties, the landlord and the tenant. There are often other players who may have an impact and can help in overcoming the situation as such. But similar to the post-financial crisis, when the banking sector saw a number of new initiatives to stabilize and to better prepare the sector for such events, I think our industry too has a unique opportunity to create perhaps a contextual landscape that is based on a more symmetrical spread of risks and opportunities. And Frank already alluded to that when he talked about some hybrid leases. And then to come up with a more even playing field amongst all stakeholders. And all stakeholders, my understanding, is owners, developers, lenders, tenants, licensees, licensors, and brands.
So Theodor, you were touching on there, and so any more ingredients you wanted to add to Frank's list there of things you'd like to see? Because obviously Frank's put his 2 ingredients in there as a lower base rent and a higher variable rent. You're talking anything else that you think would be really good to see?
Well, I think there is a number of issues which could be addressed. I think what we should be looking at is an abstract version is to make something smart and resilient. These are two words which the banking sector also used 2008, 2009, when they looked at some packages, regulatory packages. And this, I think, goes beyond the actual sustainable lease level, that goes at looking at guarantees, how guarantees are structured, perhaps looking also at issues such as rent-free periods are structured, or even the licensor, to which extent can he contribute to any potential cyclical downturn and have some kind of liquidity ready in case of such a black swan event.
Now, Erik, you're seeing it from probably both sides of the fence. So, what about your perspective on this and sharing of the pain?
Yeah, I think the pain is pretty much being shared, right? Because if you look at the operators, paying the rent is one thing, right? There's a lot of pain already, kind of even before paying rent at the moment, right? So that's a key part there. And then, of course, from the landlord's perspective, there's pretty much no rent being paid at the moment, right? So there's a pain there, particularly then again vis-a-vis the bank, who in turn is also not charging the interest and the amortization at this point, right? So at the moment you can say, yes, the pain is being shared and everybody is very amicable in terms of how to deal with it. But going forward, what is how could you kind of change these contracts around such that the pain is even better shared? I agree with what Theodor and Frank are saying in terms of fixed rent, right, and increasing the variable rent is a very welcoming part for the operator, because in an extreme case like now, it's simply unbearable for the operator to meet any kind of fixed rent. But yeah, we're going to have to see how that's going to be dealt with in leases.
I don't know if you were listening to the previous panel, but they were talking about alternative classes, and there's sort of part of it that sort of the new entrants to this will be the ones that perhaps drive the significant change, the new entrants to the market, because they'll be wanting to shake things up and perhaps new ideas on the contractual relationship. I mean, we heard previously about how the collective, they're talking about their customers and their clients and their members. It's not landlord and tenant relationships, and even just the phraseology. So what do you think is going to need to, we've obviously had a big shock, but what else is going to be needed to change that contractual dynamics so that you get a bit more of a level playing field?
Yeah, I think the problem is that human nature suggests people will stick to the relationships and the structures that they're most familiar and comfortable with. And so I bet there are a lot of landlords who are now drawing a line between today and some point 2 to 3 years off, during which period they can move back towards the new normal, which is the same as the old normal. And I think my point is, I'm not sure that that's going to work. And I don't think that triage to get us through this immediate crisis, which is good, is actually going to help us in the next crisis. And we really do need to think about that buzzword sustain. If the model isn't sustainable, and this down cycle has demonstrated that it really isn't, then how can we design a better model? What we have to do is make sure that neither party is fundamentally disadvantaged, but that the structure of payments and the sharing of risks and opportunities is more equitably distributed at points during the cycle. I think it's entirely feasible, but my fear is that a lot of people will be trying to navigate their way back to the old normal rather than planning for the new normal. And this will eventually hurt hotel real estate as an asset class if we can't collectively work out a better solution.
But yeah, I think that's also part of it, right? Because if you look at the cycle, and I mean, you can't change the underlying business of hotel real estate, right? The underlying business is simply a cyclical business.
Yeah.
Right? And when you know, a lot of investors, right, when the cycle is low and times are hard, right, the group of investors that is open and comfortable investing in hotels has historically and is always the same, narrowing down, right? And then when times get better and there's, you know, the performance seems to be more, you know, robust, you know, more investors are coming into the market because they see the kind of upside, right? And I think now you're going to again get a big awareness of, you know, the underlying risk. Now, of course, this is a very extreme scenario, right? But the fact is that there is seasonality, and you know, coming up with a lease kind of program going forward that addresses that in the right way, that's going to be the interesting thing. And it's going to be interesting to see which investors are going to be sitting on the other side, and where their pain points going to be in this.
You pick up a good point there, Erik, about investors, and that sort of takes me into sort of a bit of valuation there, because it's a very developed asset class, and you know, does there need to be a change in the sort of the way you value the hotel asset for this to then feed through into that balance between landlord and tenant?
Can I jump in there just to say that I think the valuation methodology is probably one of the biggest flaws in the hotel real estate asset class, because the methodology that the valuers are required to follow results in overvaluations in the upcycle and undervaluations in the down cycle. And really the focus should be, kind of like the discussion we're having, on a maintainable value that survives through the cycle, which many of the industry players aren't interested in. Because if you're acquiring in an upcycle, you don't want to know about the maintainable value. And if you're buying in a down cycle, the lower the better. But it's not helpful to a sustainable industry to constantly be distracted by the amplitude of the curve rather than looking at what is reality. If something bad happens during an upcycle, the value is going to shift immediately. And if recovery is inevitable, may not feel like it at the moment, so values today aren't really values at all, they're price. So the valuation methodology gives you a good reflection of price and almost never goes anywhere near value itself.
Erik or Theodor, do you want to jump in on that?
I mean, the issue with the valuations, and this is partly the issues, you know, of being an operator, right? The values have just been going up and up and up because real estate, you know, has been really, you know, the big favor. And for an operator to secure any kind of asset, right? The commitment, the financial commitment that you are expected to be making, particularly in the old kind of model, becomes unbearable, right? And just is becoming so operationally levered that even the slightest shift kind of puts a lot of stress on that tenant landlord relationship. Therefore, how can you kind of stabilize that value a little bit more is difficult, but it forms a big part of setting the operating agreements, because of course the investors have a certain return profile.
And Theodor?
Yeah. To this note, and in my role as fund managers, there's one thing the fund manager doesn't want to do, want to devaluate an asset. And you get this when you have a sustained lower income, meaning, and that's to the point of sharing risks, having a more hybrid contract, where you all of a sudden you have a lower base fixed rent and a higher variable speculative income. And the speculative portion of the income is generally valued at a discount. So therefore, if we would go this direction, and inevitably probably will need to go this direction, then there will be a sustained devaluation of the asset. But going forward, this is what I mean by having properly take the pain and being more mature, having coming out of this black swan event, and not being driven by this vicious capital markets, as we have seen over the last 5, 6, 7 years, which has built up the tension. On one hand, decreasing cap rates, on the other hand, driven by super amount of liquidity in the market and low interest rates, and then the development of pipeline of 10, 15, some cities even 20% new inventory. So which in return has created additional pressure on operators to perform in their offers, in their lease agreement offers, to with higher rents. So therefore, there must be a break. There must be some kind of perhaps even regulatory break, where we must create some kind of pockets, liquidity pockets, whether it's on the operator side, on the owner side, on the lender side, or on the licensor side, which then caters for such events. But by no way can we be driven anymore by these natural dynamics, the almost natural dynamics of the capital markets. We need to learn to make, like the banking sector did, something resilient, a resilient market.
So there, Theodor, you're sort of touching, and you've touched in some of your comments back to the banking crisis of 2008. Is there any sort of particular lessons that you look at from 2008 and go, actually, this is a lesson that the hotel sector should take and apply in this one?
Yeah, well, I think what happened after 2008 is there were 3 main objectives which were pursued on a regulatory level. The first one was to improve the resilience of the individual banks. Now replace banks by hotel, thereby reducing the risk of financial institutional to fail. The second one is to improve the resilience of the financial system, replace financial system with the industry as a whole, limiting the risks of spillovers. And 3, reduce the risk for taxpayer, leave the taxpayer there to bear the cost of future banking crisis. And then considering that our industry in some countries contributes 5%, in other countries around about 8%, like in Germany, I think in the UK 10%, and other countries like Austria, like mine, 15% of the GDP. I think there is an inherent interest to get some kind of regulation into our sector as well.
Frank and Erik, any comments? What do you think about regulation?
Well, it's interesting because regulation basically is just coming up with a set of rules to try and reform the chaos. But what's interesting is the drift towards more direct institutional investment into the sector is happening. It's a trickle, it's not a flood. But what you're seeing there is that the funds that don't require legally to have a lease to avoid being an employer and so on, which many of the continental European funds require that, they've appraised the sector over time and realized that their profit stream over a cycle or 2 cycles is actually better by being fully exposed to the NOI rather than trying to work out what is the most appropriate level of lease or what will the market pay me. So that actually is very encouraging, because if that direct institutional investment experience is positive, then the funds that are struggling can move towards more synthetic lease structures to allow for their regulatory requirements to not employ and not run trading businesses and so forth. And that is the gateway to more hybrid variable structures. But you know, the underlying issue that benefits or doesn't benefit all of us is promoting the industry as a safe asset class to invest in. And we need to collectively resolve this. I don't think that it's the fault of either of the parties in terms of the landlords and the tenants. I think it's just an inevitable consequence of the structure.
Yeah. I think, Erik, you were going to say something as well.
No, I agree with what Frank says, right?
Like
But I think, you know, again, I think it's also a function of, you know, where the demand for assets is going, right? And if the market is heated, more funds, right, are moving into you know, alternative classes. You know, we like to look at hotels more and more as becoming, you know, part of the mainstream assets, but you know, you clearly see more capital coming into our sector when times are going well. And, you know, again, to kind of, as an operator, make a chance of securing one, you need to solve for higher value. I think going forward, I agree with what Frank's saying, right? And personally, I think where you may see a shift is indeed a recognition that the exposure to the variable income, you know, over time is actually could be more beneficial, right? And what you're really trying to solve for is the worst case scenario to get some income. So hopefully we can see a lease profile that is going more to the direction where the base lease is going to be lower, but maybe a slightly stronger guarantee behind that, right? So that kind of, you know, worst case income may be becoming a bit stronger. Right, and therefore, you know, operators can also, you know, better be able to give that comfort, right? But the large income profile is much more aligned in terms of that it's a fact of or a function of performance. And I think that would be that could maybe be a good way to make it a bit more digestible.
Thanks, Erik. You've just been talking about, you know, is there a need for regulatory input, but sort of obviously regulation takes a while to come through, but so in the meanwhile we've got sort of collaboration. We have to work together to try and get through this period. Erik, you're operating, in fact all of you are operating across Europe, and I just thought it'd be quite interesting to explore that collaborative approach. And are there any differences between countries? You know, is one country perhaps more collaborative, UK perhaps not? So welcome your thoughts. If I can start with you,
so
Erik.
You know, we have an asset in France where we have a lot of food and beverage retail, and there, you know, from the immediate kind of, you know, outbreak and the immediate day that the you know, food and beverage units were supposed to close down, they came with a regulation, right, that rents could not be charged for as long as the unit was closed. Right, and you know, the rent that was then being kind of you know, waived should then be spread over the next year. So that's kind of the most extreme case. I think if you know, I think Germany has also come up where they have put quite a bit of protection on the landlords, right? So that if you're not able to pay the rent, you know, the landlords cannot immediately kind of, you know, start going the legal route. Right, so they're kind of being forced to consider a bit of a workout scenario. In the Netherlands, it's different. It's really a commercial discussion still, and it's very interesting to see the spread of how kind of landlords are approaching this, right? And in the UK, it's of course there aren't there's no I'm not aware yet today of any kind of regulatory kind of input in terms of how to deal with it, right? So it still feels to me as well a mutual discussion between the landlord and
the UK government has taken away a lot of landlords' powers to take tenants, threaten tenants with eviction as a result of non-payment. And this week, we're anticipating a code of conduct to come out that will apply to this sector as well. So it'll be interesting to see. It'll be a voluntary code of conduct, but it'll be interesting to see whether it's worth the paper it's written on.
Is that going to come out before the next rent payments are kind of mostly due?
That's what they're trying to do before the 24th of June, yes.
Please send me a copy.
I will do. I will. Theodor, I think you were about to say something.
If I may add to that, I think we can differentiate between three kind of efforts. One is mitigating, two is preventing, three is stimulating. And trying to mitigate, you mentioned Germany before, Erik. I think there's lots of room to be done. Still, yes, there is some kind of moratorium by the German government for 3 months rent payment, but or not being able to terminate the lease agreement. However, there's so many loopholes in that, meaning what would happen if the tenant if the landlord would just pull the guarantees. Then if there's a bank guarantee, the tenant will have to fill up this guarantee, and therefore there is an extraordinary termination clause. Two, perhaps even more severe. Once the moratorium is finished, is by the end of June, July might be extended, then who guarantees that the level of business is at the same level as it was 2019? Who guarantees that those bullish rent agreements, rent levels can actually be achieved into going forward, 2020, 2021? And how is on earth is the tenant going to be able to make his liquidity work, his cash flow work? So there's many questions going forward which have still not been resolved and which really put the tenant in danger.
No, I was just going to ask. I can see that our time is about to run out, but Theo, it's a good point. Do you think there's going to come a point? I think we are all we're talking about collaboration and sharing the pain, but there's going to come a point, is there not? Or do you think that somebody's going to say that's enough is enough? I have to take action. The government has said I've got to play nicely, but now the moratorium's finished, gloves are off. Let's go for it. I guess quick. I can see Andrew there, so very quick, yes or no, do you think we're going to end up in a crunch point soon, and when do you predict? I'll start with Theodor.
I think they will, whether it's the government, whether it's the banks or the investors, they will, depending on the sustainability of the business and their capital, the type of capital they are.
I think September, October are going to be important months to kind of see how things are progressing kind of over the summer, and what really is the likelihood of a new pandemic kind of coming up. But there comes at one point where it's the landlords or the banks stop being nice and just trying to find a mutual agreement.
Yeah, Danny, I think the difference is going to be how much liquidity the tenants had as they entered the crisis, and I think many of them are going to struggle in the autumn. But I think the big peak is going to be at the end of Q1 next year, where many of the European governments have allowed deferral of corporation tax and VAT. So they're going to have still suppressed trading and massive tax bills and deferred rent, because most of these arrangements are deferrals, not cancellations of rent. And I think that's going to be the perfect storm. So we have about 9 months to sort this out as an industry, or there's going to be a major restructuring.
I've got a quick question.
Yeah, no, I fear the same. I think at the moment we're all trying to work through this, but there is going to be too many economic pressures coming as
Indeed.
government moratoriums
I've got-
and everything
I've got a
gets
quick
lifted,
question for you,
that it will change.
Oh, please, Danny, yes.
Can I just share the results of our poll?
No, go for it.
See, Andrew's going to stop me. That actually the majority, 66% of you think that the landlord should bear the economic consequences of COVID. So thank you for
and a quick
voting
question for
through
your
our
panel,
poll
if I
throughout our
might,
debate.
Danny. I've spent the last couple of decades trying to persuade my readers that hotels are an institutional quality asset class. Has this crisis just proved that I've been wasting my time?
Certainly not, if I may step in here. From my previous times with some other fund managers, hotels always have yielded the highest return amongst all the asset classes. We certainly, having spoken to our supporters, they will further support the hotel as an asset class, and will just perhaps want to see some changes in the relationships. But otherwise, there's full support.
My view would be to say I think it very much can be, but there needs to be an understanding of what it is, right? And the income profile is a cyclical one, and as long as the institutional investment world can get their heads around that principle, right, and they can protect an element of it, right? And then it depends on the operator and their balance sheet, how strong that protection can be. Because of course, there's less and less kind of big global operators that give kind of leases. As long as they kind of understand that, then I think there's a very well model that is still suitable. But it will be, one that is a bit more hybrid, right? It's a bit more, marked towards the underlying operations.
And Andrew, just to finish off, I think the real estate that's represented by the hotel sector has every opportunity to emerge in an even stronger position after this crisis, because you're always looking as an investor at alternative asset classes. So, if you're looking at retail or offices, they have their own problems. And actually, the hotel industry has done very well. The banks really got their house in order after the GFC, and most of them entered this crisis with LTVs averaging between 50 and 60% rather than 70 to 80% a decade earlier. We really have a very simple fix here, and it's very simple and similar to what the banks did in terms of self-regulating with a bit of stress testing the amount of lending they were doing, and that is stop this auction process that drives lease coverage down to 1.1, 1.2. Those are unsustainable levels, and rather switch the emphasis to a sustainable coverage of the lease, and maybe top up with the variability and a different approach to guarantee structures and who's contributing what to that. And I think all of that will really help hotels as an asset class.
Great. Thanks. Thank you, Danny. It's a great panel. Thank you, panelists. Thank you. Brilliant.